Taxes are one of the most important issues in planning in retirement, and the rules governing our income taxes change as we retire. Most retirees don't know this, and so they come unprepared and learn really by trial or error. I'm hoping the information you get in this video allows you to be more proactive in your tax planning. Hi, my name's Sally Boyle, advisor to individuals and families who are approaching retirement within the next 5 to 10 years. So what are the issues regarding taxes in retirement, and how can we prepare for them? There are many, obviously, often very individualized, depending upon where you have worked, how you have saved, and what the particulars are of your family. But let's examine 8 broad areas for tax retirement tax strategy. Many people consider at first moving to a more friendly tax state, and this can be a good idea, especially if you're moving from a state with income taxes to a state without income taxes. But of course, those aren't the only considerations. First, you might consider the cost of living. While there may be no income taxes, how do housing costs compare? Groceries, utilities, and healthcare, especially healthcare. And how's the quality of life? Do you have educational opportunities? Do you have communities of your age that recreate and are interesting? And again, is the healthcare appropriate? And of course, weather and climate are important, but what about other taxes? What about sales taxes, excise taxes, property taxes, local taxes? These could all offset your state income tax savings. For example, here in New Hampshire, we have no income tax, but we do tax dividends and interest, which are often core income providers for retirees. So more friendly tax states are Wyoming, Nevada, Florida, Tennessee, and Alaska. And if you want to compare, you can use online tools. One is called Tax Foundation or Wallet Hub. They offer a state-by-state comparison. You can input your income and other details and see how the taxes might vary. Now, the next thing you should consider is diversifying your income sources. And this is something that you're going to do well ahead of retirement. You should take advantage of both pre-tax and after-tax retirement savings accounts, 403Bs, Roths, HSAs, because the advantages of each are unique. With a Roth account, you pay taxes when the money goes in, but all withdrawals come out tax-free, and you enjoy years of tax growth free. But many of us take advantages of our pre-tax 401ks and 403B accounts because our income tax rates today are going to be higher than our income tax rates in retirement. And we also have matching by our employers. Now, these pre-tax accounts can be converted to Roth accounts later if it makes sense. And sometimes that can be done strategically, especially in the early years of retirement, if you choose to delay your Social Security. But once you have these established accounts, then you can plan an efficient retirement income withdrawal strategy, mixing pre-tax distributions, after-tax distributions, infusions from your taxable account, with an eye towards minimizing your taxes. And the result will be that you can have a lower tax bill. So the next strategy would be to reallocate and maybe even relocate some of your investments so that they are tax efficient as well. And we talk about this in another video on our channel, and you might view it, but it's all about investment location. For example, a taxable bond, and we own taxable bonds generally because their interest rates are higher than other options. Those taxable bonds should be located in your retirement accounts as opposed to outside in your taxable accounts. Their rates are higher than tax-exempt bonds, But depending upon your tax bracket, your tax exempt bond should be in your taxable account, as well as your dividend paying stocks. Those should be held in your taxable accounts as well because of their tax favored status. If you receive regular dividends from publicly traded US corporations, as well as certain foreign corporations, they're taxed at a capital gains rate, which, depending upon your income, can be as low as 0%, 15%, or 20%, depending upon your taxable income, but generally below your regular tax rate. Now, in your taxable accounts, you can also take tax loss harvesting, and this is where we take securities, we sell them at a loss in order to offset capital gains in the sale of other properties. This again should be strategic. You should take your losses strategically when you know you have gains to be realized. In fact, you can take $3,000 more in losses than your capital gains and offset your ordinary income, which could be your Social Security, bank interest, any form of taxable income. One of the things you should also consider is postponing distributions from your retirement accounts. We all know that we have required minimum distributions from our taxable accounts, and we can delay those. It used to be that our first RMD had to be taken when we were 70 and a half, but that was raised to 72 in 2019. And it was again to 73 in 2023. So this postponement could allow you to take other income while in lower brackets. And you can maybe take the sale of other assets while you're delaying. As we said, it could allow for the sale of assets where you have realized gains, or if you have very outsized pre-tax accounts, you could continue Roth conversions. Now, this conversion can have some estate advantages, so that might be why you want to continue it even after taking Social Security. But care needs to be taken when you delay your RMDs because, of course, your accounts grow larger at a time that the rate that your RMD is calculated goes up. So you could also be complicating your taxes. As we've mentioned before, you can be very strategic about your Social Security income and consider other income sources. We said that you can delay your income or your Social Security income to age 70. You can consider that strategically with your spouse's Social Security. Maybe they would take it earlier, maybe a little bit later. But the point is you can delay it because the credits boost your income if you delay to age 70 and able to do that. But once you start to take it, you consider your other income as well, because not all Social Security benefits have to be taxed. None of them can be taxed at certain income levels. 50% of them are taxed at income levels that are $25,000 from all other sources. And 85% are taxed when your income is at $44,000. Now, I know that that's fairly low. These thresholds are low, but worthy of consideration if it can afford you to minimize the amount of your Social Security that is exposed to taxes. And a final consideration is charitable giving, and it's always available to you. But in retirement, you can send all or some of the portion of your RMDs to a qualified charity, up to $100,000, and avoid all the taxes on that you donate. It's more efficient than donating from an after-tax source, and really can be a very tax-efficient strategy. So I hope these 8 strategic ideas help you with tax planning and retirement, even if you are 10 years away from retiring.